Sorry, yeah, I have to speak to microphone because we have also online viewers as well. It means we are not only in this room, but I suppose in many offices in ministries as well. As I said, we will have a lecture for approximately 40 minutes, and after that, questions and discussions about the topic. I think we can start, and Mr. Reglinga, the floor is yours.
Thank you very much. It's a pleasure to be here. It's nice to be in Latvia. I came here mainly to welcome Latvia as the 18th member of the ESM, the European Stability Mechanism, which is a logical consequence of Latvia joining the euro area. And I will talk about the ESM in a moment. I already had meetings this morning with the finance minister, with the central bank governor, with the prime minister. So it's very good to be here and meet the government. But I thought it's also useful to talk about where we are in the euro crisis, what caused the euro crisis, and what we are doing to get out of the euro crisis. And I will try to explain that we have come a long way, that we have a strategy that is actually working better than many people believe. And I'm very happy to answer all your questions afterwards. I hope you can see that screen. That will make my life a lot easier, because then you can follow what I say. You can also find these slides on the ESM website later in the afternoon, so you can download it if you want. So let me start by saying a few words why we got into the crisis. What were the causes of the crisis? And I want to point to 8 reasons for the crisis. Can you read it? Okay. One can probably have many more, but I want to focus on the 8 main causes for the euro crisis. The first point is a very general one. When 11 member states in 1998 decided to start European Monetary Union, they had met the convergence criteria, they had made certain efforts to get there, but once they were in the euro area, many of them forgot that being a member of a monetary union means that certain policies are no longer possible, and that certain policy developments have to be contained in light of being the member of a common currency area. For instance, wage developments can only go up in line with productivity developments, otherwise competitiveness is lost, and there will be a large trade deficit and economic developments will slow down. So in a very general sense, after monetary union started, member states had not yet internalized this need to adapt policies to the fact that they were in a monetary union. The second is that monetary union brought a convergence of interest rates to a very low level. 20 years ago, in the early 90s, we had a situation in Western Europe where countries like Germany, Netherlands, Austria, Finland had low interest rates, while countries in Southern Europe, particularly Italy, Greece, Spain, Portugal, had interest rates that were 5, 6, 7 percentage points higher. As we moved towards monetary union, there was convergence, and that was unavoidable. It was a convergence to the low level in Northern Europe, but that meant a strong monetary push in Southern European countries. Monetary conditions became much easier than before. And that was a one-off effect, but a very strong one that created some bubbles in certain countries. The third reason for the crisis is economic surveillance was too narrow. Economic surveillance means that the countries that are in the monetary union are supervised by the European Commission and the European Central Bank. Monetary policy, economic policies in general are monitored, economic developments are monitored, but the focus was initially very much on the fiscal policy side, and we learned in the crisis that that was not enough. I will come back to that because we have drawn a lesson from that. There's a fourth reason that only economists will understand, but I assume that most of you are studying economics. There are methodological problems with calculating structural fiscal deficits or balances. What does it mean? It means that when a country has a bubble, is overheating, there's a lot of revenue, there may not be any fiscal deficit, so the fiscal situation may look very good, but it looks only good because there are temporary bubble effects that will disappear when the bubble disappears. We try to take these effects out by calculating cyclically adjusted fiscal balances or structural balances, but we are not very good at doing it. Our methodologies are not good enough, and that's, for instance, why in the years 2004, 5, 6, countries like Ireland and Spain had nominal fiscal surpluses of 2 or 3% of GDP, but the real underlying balance was much, much worse. The structural balance we know today in these countries was 5 or 7% deficit, but we didn't know it at the time. We don't have the methodology to calculate it in real time. A fifth reason is that Eurostat didn't have much power. Eurostat is the statistical agency of the European Union. Eurostat has been around for a long time, but traditionally they only collected numbers, data, harmonized them, and published them. We had never given Eurostat the power to check the numbers. After the crisis, when we learned that Greece had cheated on its numbers for many, many years, it was decided that Eurostat should have the power to go to the country and check the data. That's what they do now, and that's why on this front we will not have surprises like we had in the case of Greece in the future. The sixth point is that financial market supervision was too narrow and too national, not enough cross-border, which is not appropriate because the large banks all operate across borders. And financial market supervision was insufficient because until the crisis, the mood was very much towards light regulation, light supervision. As the former chairman of the Federal Reserve, Greenspan, often said, markets will regulate themselves. We know today that that was a mistake. We have learned from that and we are drawing conclusions. A seventh point, there was no crisis resolution mechanism in the euro area. So the institutions that I manage, EFSF and ESM, did not exist. Now they do exist. I will talk about that in a moment. And the final point is we should not forget that the euro crisis is a homegrown crisis. It started in the member states and was facilitated through insufficient supervision, the non-existence of certain institutions, but it was made so bad and so difficult because the global financial crisis hit at the same time as the euro homegrown problems became visible. So it's a bit like in Latvia when the real estate bubble burst, and a year later in Ireland and Spain. About the same time, the global financial crisis, which had its origin in the United States, also hit. And it was a combination of the euro problems with the global financial crisis that made the situation so difficult and why some countries are still suffering from the consequences. So this is a very quick overview how I see the reasons for our euro crisis and why it became so big. But let me mainly talk about this afternoon about what we have done to contain the crisis and to get out of the crisis. And I see we have a comprehensive strategy adopted over the last few years in response to the crisis. I know that for many people it looks very much ad hoc what has been going on, late night meetings, weekend meetings, summits endlessly, and it doesn't look like there was a real strategy behind all this. But looking back, one can define the strategy quite well, and it has four main components. First, the comprehensive reforms and adjustment at the national level. I will talk about that. I will talk about each of these elements in a moment. Second, the better economic policy coordination in the euro area. This is important because the general criticism that we heard against European monetary union from the beginning, from the 90s, particularly from some Anglo-Saxon academics, was that a monetary union where only monetary policy is centralized, one interest rate determined by the ECB, but the rest of economic policies is done in a decentralized way at the national level, cannot work. That was always the criticism. My answer is it can work, but the economic policies need to be coordinated. That was not done well enough. As I said in the beginning, countries did not really respect the constraints that being member of a monetary union brings. But now we have done a lot to improve this system of economic policy coordination. So that is the second point of the strategy. The third point of the strategy to get out of the euro crisis is to strengthen the European banking system. And the fourth and final point is to create new institutions, to close institutional gaps in the initial design of monetary union. And we have mainly created EFSF and ESM. They didn't exist before the crisis. So that is the fourth element of the crisis response. And as we are moving out of the crisis now, the focus of policy making is returning to growth, which of course is the ultimate objective of economic policy making, to increase standards of living and create more jobs. So let me talk mainly about these four elements: national adjustment, better policy coordination, stronger banks, and new institutions. So what has happened at the national level, the first point? As I will explain more in detail later, 5 countries have borrowed from EFSF, ESM, Greece, Ireland, Portugal, Spain, and more recently Cyprus. And these are the 5 countries that are now implementing more reforms than any other country in the EU. This is confirmed by statistics of the OECD that puts out a ranking of countries according to their reform efforts. Greece is on top. It does not mean that Greece is doing everything that is necessary, but they are doing more than anybody else because they have a much longer way to go than anybody else. So there's progress, doesn't mean that everything is perfect. Ireland has done a lot. Portugal is on the right way. Spain is doing extremely well now. So this reform effort at the national level has really started in all these 5 countries that borrow from EFSF and ESM. This is also confirmed by a second statistic put out by the Lisbon Council, a think tank in Brussels. They also rank countries according to their reform efforts and to their improvements in their fundamentals. Again, the 5 countries that borrow from us are among the top countries. Greece is again at the top. You see that other countries like France and Germany are far behind. They are not under any adjustment program. They don't get emergency financing. There's no conditionality. So they are not doing that much. So the 5 countries are really doing something, and we see the effects. On this chart, you see on the left-hand side competitiveness, and it's a cumulative line for each country that shows how unit labor cost improved massively in the countries at the periphery. You see the line at the bottom, that's Germany as a benchmark. So compared to Germany, Ireland, for instance, in 2008 had unit labor costs that were 45 percentage points higher than in Germany when you have the base period in the year 2000. So it's a similar situation in these countries. Again, I'm talking about the countries that borrow from us. And it's a bit like in Latvia, where competitiveness was lost before the crisis. Unit labor costs increased much faster than in trading partners. And the crisis triggered then a reversal. And we see that in the periphery of the euro area, all the countries had their turning point in 2008 or 2009, and since then have come a long way. Greece is actually back to the German level, because Germany, for cyclical reasons, is now increasing faster than the euro area average. This is for a healthy reason. It's within normal cyclical limits. And Greece is falling, so interestingly, the lines between Greece and Germany are intersecting this year in 2014. But all countries are making good progress. That also means on the right-hand side that the current account situation has improved dramatically. These countries had deficits of 10, 15, 18% of GDP in 2007 and 2008. I remember Latvia had a current account deficit of 20% of GDP. But as competitiveness is improving, also because GDP has declined and therefore imports are falling, the current account deficits have disappeared in all these countries. And it's not only the import compression, exports are growing in all these countries. So this clearly demonstrates that there is reform progress in these countries. You also see it on the fiscal side, the next slide here. Fiscal deficits are coming down in all euro area countries. On average, the euro area has a deficit now of 3% of GDP, which, by the way, is about half of what the US, UK, and Japan have. But every individual country in the euro area is committed to bring the deficit first below 3% of GDP and later on to a balanced situation. So real progress at the national level, and for me this is the decisive reason why markets have stabilized. As you know, 2 years ago, many market participants, particularly in New York, expected the euro to disappear. This perception is completely gone today, and this is mainly based on these adjustment efforts of countries that had problems 2, 3, 4 years ago. And markets are rewarding this progress. Interest rates for these countries have fallen dramatically. In countries like Portugal, for instance, the interest rate today, and these are 10-year government bond yields, is only about a quarter of where it was 2 years ago. But interest rates have come down for all these countries that are making adjustment efforts. And importantly, the countries have been able to go back to the markets. Ireland, Portugal, Spain have all been able to go to the markets again, even with 10-year government bonds, which was not possible for 2 years. They can issue 10-year government bonds at reasonable interest rates. Portugal still a lot higher than the others. Portugal today is just below 5%, while Ireland is down to 3.2%, Spain 3.6%. So markets are rewarding these adjustment efforts. So that's my first point of the comprehensive strategy. the national adjustment in the countries that lost market access. The second point to remember is the improved economic policy coordination. Important because we learned in the crisis that countries' economic policies had not been convergent enough. They went into all kinds of different directions, not taking into account sufficiently the needs that membership in a monetary union brings. What have we done? We adopted more comprehensive rules in many more economic policy areas and more binding rules. The Stability and Growth Pact, which governs fiscal policy and has been around from the beginning, has become much stricter. There's also much less room now for political interference by national governments. That means the role of the European Commission, which is at the center of the monitoring exercise, has a much stronger role today, and proposals from the Commission are much more difficult to stop in the Council than before. Also, member states have introduced the European budgetary rules into their national legal systems. I know Latvia also adopted the Fiscal Compact recently. Other countries have done that. This has the advantage that if in the future, which I don't hope, a country decides to break a European budgetary rule, it would also at the same time break its own national rule. So there's another hurdle against misbehavior here. We have something called European semester, which tries to coordinate fiscal policies early during the first half of the year when member states notify their partners and the Commission about their budgetary plans for the following year. And the national parliaments, when they adopt the national budget, and that remains the responsibility of national parliaments, they do it towards the end of the year, but by then they have the comments from the Commission, from partner countries about their intentions, so they know what the rest of Europe thinks about their plans. So there's much more focus on spillovers. Particularly large countries and their fiscal policies have, of course, an impact on neighboring countries. And there's now a strong emphasis on broader macroeconomic imbalances. So we have something called excessive imbalance procedure that focuses on many things that we learned during the crisis that can go wrong, like excessive credit growth, real estate bubbles, private debt, loss of competitiveness. All this is now monitored permanently by the Commission, regularly discussed in the Eurogroup, the group of finance ministers of the Euro area, where since January also the Latvian finance minister has a full seat. And when a country threatens to show a macroeconomic imbalance, then there can be recommendations from the Eurogroup to that country, and if these recommendations are not followed, there can be sanctions after a while. So this is the second element of the crisis response, better economic policy coordination. And let me move to the third one. We need to strengthen the European banking system. We do that in many, many ways after the crisis, because certainly the global financial crisis that I mentioned earlier was triggered by financial markets, mainly in the US. So we all learned that more supervision is necessary. But in Europe, we have the special problem that we need to capture a situation where the big banks work in many, many different countries, not only in their home country. That's why already 2 years ago, we created new supervisory authorities for banking, insurance companies, and securities markets, EBA, EIOPA, and ESMA. These are real new institutions, which implies the transfer of sovereignty. They have powers that before were only at the national level with national supervisors. We also created the so-called ESRB, the European Systemic Risk Board, not well known in the public, but very important, particularly for monetary union. The ESRB is managed by the European Central Bank. The president of the ECB is the chairman. And their mandate is to identify and monitor macro-prudential risks. That's another lesson of the crisis, to watch out for macro-prudential risks. That was ignored before the crisis. Supervisors normally went to a bank and looked at the loan book of a bank, loan by loan, whether it made sense, whether the loan was serviced, what was the risk for the bank. But there was nobody who added up all the banks with all the loan books across different borrowers. We had by now classical situation in Latvia, where maybe a loan from a Swedish bank to a Latvian real estate developer made a lot of sense. But if one added up all the loans from all the banks outside Latvia to all Latvian real estate developers, one could see that there was a problem. So this is done now in a systematic way by the ESRB, and this is particularly important for monetary union. By the way, United States, UK also created new institutions like this with a mandate to look at macroprudential risks. But in the monetary union, this is more important because in the area of supervision, there are tools available which can be used in a country-specific way. Monetary policy in a monetary union cannot be used in a country-specific way. It's the same interest rates for every country. But supervisors have their tools available at the national level, even in a monetary union. And for instance, 5 years ago, when the Irish real estate bubble became very big, the Irish supervisors could have told their banks not to finance 110% of the purchase price of a real estate project, which is what happened quite often in Ireland. They could have told the banks to finance only 80%. They had the tool available, they didn't use it, but there was also nobody in Europe who told them to use this instrument. So in the future, that will be the role of the ESRB. On top of these institutional changes and innovations, there's a lot of going on in the area of financial market reform. Basel III is something that's implemented at the global level. Of course, Europe has to find its way in the global system. It's not enough to look at Europe. Basel III means a lot more regulation and supervision for financial markets. We have seen in Europe a huge increase in bank capital. All major European banks have now core Tier 1 capital ratios of 9% or more. And since 2008, so during the last 6 years, EU banks have raised about 450 billion euro in fresh capital. So a huge amount, maybe not enough, but a huge amount so far. Regulatory frameworks are now harmonized at the national level through EU regulations and directives. There are new capital requirements for insurance companies. There's the BRRD, which is the abbreviation for Bank Restructuring and Resolution Directive, which will bring a new regime of bailing in of bank creditors in times of crisis. DGSD means Deposit Guarantee Scheme Directive. So many areas are covered here, and a lot of attention is paid by finance ministers and head of state in this area, particularly under the heading of banking union. Banking union is the one area where we still have to do most of the work now at the EU level, because the effort is to create, the objective is to create a banking union, which would mean a single market for banks. And this is important because we have seen that through the crisis, a fragmentation of the European financial market has happened. which shows up in very different interest rates for Southern European countries compared to Northern European countries. What are the elements of the banking union? The first one is the single supervisory mechanism, SSM. Here the decision was taken at the end of last year. The ECB will take over this role from November this year. I already mentioned the BRRD, Bank Recovery Resolution Directive. This will create a new uniform framework for bank recovery, including bailing in of bank creditors. Discussions are still ongoing on the single resolution mechanism and the single resolution fund, which are important complements to the single supervisory mechanism. Here are negotiations ongoing between Council, Commission, and the European Parliament. Another element of the banking union is that the ESM, my institution, will get a new instrument that doesn't exist so far. Direct recapitalization instrument, which means that if this is approved by finance ministers in a unanimous vote, we from the ESM can take capital in one single bank, provide capital. That will be a new operation for the ESM. And finally, we see the harmonization of national deposit guarantee frameworks, another element of the banking union that is important to create a single banking market. As you can see with all these abbreviation and technical expressions, this is a huge enterprise. Quite European in the sense that not many people understand fully what's going on, because there's so much. It's technically very complex, but it is an important area because the negative consequences of not having a banking union are very clear. It would make it more difficult for countries like Greece, Spain, Italy, Portugal to adjust, because it's not only the governments that have to pay high interest rates, also private borrowers in these countries have to pay substantially higher margins on interest rates than the Northern European neighbors. And that means in a single market where companies compete with everybody else in the EU, they have to squeeze costs somewhere else. That can only be labor cost. That means they have to depress wages further, which means less consumption in the country, less domestic demand, and therefore decline in GDP. This is a result of this fragmentation in banking that we see as a result of the crisis, and banking union should reduce and eventually eliminate this problem. So banking union, stronger European banks, that's the third element of the crisis. And the fourth element are new institutions, institutions that did not exist before the crisis. When monetary union was designed, nobody could imagine, and I include myself here, that a member state of monetary union could lose market access. This was not anticipated. We were not able to anticipate a crisis of this dimension that we have seen the last few years, which is, after all, the worst economic crisis in Europe in 80 years. But with the crisis, we learned that it was important to have the ability, also in Europe, to provide emergency financing on a temporary basis through loans to countries that lose market access if they promise to improve their policies. This is an instrument that the world has known for a long time, because this is the approach of the International Monetary Fund, and the IMF has used this approach successfully in many, many countries around the world during the last 50 years to provide financing when the markets don't do it, but only against conditionality. Conditionality means the government has to change its economic policies and improve them. This is also what happened in Latvia. in a quite dramatic way, of course, through an IMF instrument and the EU Balance of Payments Facility. We have now imported this instrument into the euro area, first through the creation of the EFSF, the European Financial Stability Facility, in 2010. That was a temporary arrangement for 3 years, but then it became clear quickly that this was good to have on a permanent basis, and therefore the ESM was created, the European Stability Mechanism, in 2012. The two institutions work in parallel now. We have the same staff. I head both of these institutions. They have the same instruments. We can provide macroeconomic adjustment loans to member states. We can intervene in the primary or secondary bond markets. We can have precautionary programs, or we can restructure banks through loans to governments. These are the existing instruments. There's always conditionality attached to each of these instruments, different degrees of conditionality, but no loan without conditionality. What makes us different from the IMF is that EFSF and ESM have to go to the market to generate funds first. The IMF gets the money from its member central banks. That's a very convenient situation. They get it automatically. We have to get it in the markets first. That's why EFSF and ESM have become an important market player. And actually, the most important part of our two institutions are the funding side, the financing side, because we have to get the money first before we can provide any loan. The governing bodies of the ESM are the Board of Governors, the top political body. These are the 18 finance ministers of the euro area, now 18, or very precisely from next week it will be 18 because Latvia, in a legal sense, joins the ESM on the 13th of March, and your finance minister, Andris Vilks, will become the governor. The Board of Governors is responsible for the most important decisions, which always require unanimity, like a new adjustment program to a new country. The chairman right now is Mr. Dijsselbloem, who is also the Dutch finance minister and the chairman of the Eurogroup. Then below the Board of Governors, there's a Board of Directors that supervise more on a day-to-day basis our work. So they are like a supervisory board of the ESM, and each member state has one member in the Board of Directors. What have we done since EFSF was created 3.5 years ago? We are supporting 5 countries. The EFSF supports 3 countries, Ireland, Portugal, and Greece, and the ESM, Spain and Cyprus. And the EFSF will not do more than these 3 countries because the ESM is now available and will take all future cases if they are necessary. I don't see them at the moment. So EFSF is doing the 3 countries that became relevant before the ESM was created. The lending capacity of these 2 institutions is 700 billion euro. Out of that, we have committed to the 5 countries 239 billion euro, and we have disbursed so far 222 billion euro. That's a big number, of course, and it's compared by any standards, it's big. The International Monetary Fund, for instance, during this 3-year period during which we have disbursed 222 billion euro, they disbursed 70 billion euro. So we have done 3 times more. I already mentioned the EFSF will do the 3 countries, nothing else. Everything else will be done by the ESM in the future. Ireland was the first country to exit its program. This happened in December last year. They exited successfully. They are fully back to the markets. They don't need our help anymore. But of course, we will have a special relationship with them because they have to repay the loans they received, and they do it over the next 20 years. Another important institutional innovation that happened during the crisis is the potential cooperation between the ECB and the ESM, the so-called outright monetary transaction, OMT, foresees that potentially, when there is an ESM program in place, the ECB can do secondary market bond purchases. This has not been activated so far, it was not needed, but it helped greatly in August 2012 to calm down markets. It was an innovation announced by the ECB, and I signed an agreement with Mario Draghi, the president of the ECB, how we would implement it in case of need. But the good thing is that the announcement alone already calmed down markets, because markets took the message that the ECB is prepared to intervene potentially with unlimited resources in cases where there is an ESM program. That was a very positive message. So that is the story of our four elements that comprise the crisis strategy. The crisis is not over yet, but we have come a long way. The euro area has moved out of recession. We had 6 quarters of negative growth, but that ended a year ago. The first quarter of last year was the last negative quarter. Since then, growth has been positive, not strongly, but positive. As I tried to show, the borrowing countries are really doing their homework, not as fast as Latvia did it. Particularly a country like Greece has weak administrative structures. It takes them more time. Also, the starting point was difficult. It was, in the case of Greece, not a real estate bubble that caused the problems. Like in Latvia, it's more comparable with Spain and Ireland. There the origin of the crisis was also real estate bubbles, like in Latvia. But all the countries are moving in the right direction. They are all improving their fundamentals. They are all bringing down their fiscal deficits. They are all improving competitiveness. Exports are growing and current account deficits have disappeared. And I showed that, according to the OECD, they are all doing very well on structural reforms, but they must continue. Interest rate differentials are coming down between Northern and Southern Europe, have been cut by more than half, but they are still not where they should be. They shouldn't be identical. There will always be differences in interest rates, but there shouldn't be differences only because of a lack of a good monetary transmission mechanism, or because some people think that the euro area might break up. Unemployment has stopped rising, industrial production is growing again, so things are improving. But risks are there. I don't want to say that everything is fine. The crisis is not over, certainly not for the people in these countries. They feel the high unemployment, they feel the cut in income, but the adjustment efforts must continue in these countries. Certainly in Greece, Portugal, and Cyprus. Some of these countries may need additional financial support. We will know in the summer whether Greece needs a third financial program. If it needs one, it will be substantially smaller than the previous 2 programs. It will only be a fraction, but they may need a bit more financial support. Financial markets, as I said, are still fragmented, so that's why we are working so hard on banking union, but the process is not over. Important decisions are still outstanding. Also, we have to realize that potential growth in Europe is low. This is unavoidable to some extent. Of course, we have to try everything through more investment, better education systems, to raise productivity and to raise potential growth. But the demographic factors in Europe as a whole, in the euro area as a whole, are very negative. Very soon we will be in a situation where the population in the euro area will stagnate, and that has an impact on potential growth rate. And then after a while, we know that the population will decline. And therefore, potential growth will be low, and at the moment, people estimate that potential growth in the euro area is only around 1 to 1.5%, which sounds small, particularly compared to the United States, where it's more like 2.5%. But the difference is only the demographic difference. When we take out the differences in population developments, per capita GDP growth in the US and Europe was the same, identical before the crisis, and it will again be the same after the crisis, because in the end it's dictated by technological progress, and the technological progress in mature economies will be very similar over time. Not every year, but on average over time. I expect that to happen again, but it will mean that headline growth in Europe will be always lower than in the US, but it doesn't mean that standard of living grows more slowly than in the United States. It also means that individual countries in the euro area can grow faster, of course, than this average potential growth. If average potential growth is 1 to 1.5%, it does not preclude that Latvia grows at 4%. I also expect that countries like Greece and Portugal will grow much above average after a while, once they have concluded their reform process, because they also have an average per capita income and therefore average productivity levels far below the euro area average, and there's room to catch up. Latvia can catch up even more, but also Portugal, Spain, Greece can catch up, and with the right reforms they will catch up and will again show higher growth rates than the euro area average. So risks remain. The potential looks good to me if countries continue with their adjustment efforts and their reforms. We have seen in history in Europe and elsewhere that crisis can be useful to trigger these changes, these reforms. It's unfortunate that often a crisis is needed because crisis is painful. I don't need to tell that anybody in Latvia. But at least it should be used then well for the necessary reforms. And I'm sure that after these adjustment efforts are concluded, monetary union will function better than before the crisis, and the European Monetary Union will emerge stronger than before. Thank you very much.
Thank you very much for a very interesting and inspiring presentation. It's nice to know that we are learning from our past and our mistakes. And we are very happy always to see Estonia in any ranking. And I hope we have some questions now or comments. Please, the floor is yours.
You told us that much money, more than $700 billion will be put into stabilizing mechanisms of banks. And at the same time, at the end of your speech, you concluded that a big threat is demographics, and that it's crucial to our growth. And thus the question is, wouldn't it be wiser to put part of that money that goes into bank stabilization into demographics? No?
Can you say that again? It would be wiser to
divide these funds that goes into stabilizing finances in banking system into the demographics.
Into, I'm not...
demographics.
Demographics.
Into okay.
Demographical situation.
Okay, interesting question. Let me first say 700 billion is the potential lending capacity. So we have committed 234 billion out of that. So we have not spent the 700. And at the moment, I don't see the need to spend much more than what is committed. And this money, most of that did not go to banks. This money was lent to governments to cover their fiscal deficits. Some of it also went from the governments to banks to stabilize the banking system. And if that had not happened, these countries would have defaulted. And if they had defaulted, Ireland, Portugal, Greece, they would have left the monetary union by now, and Europe would be a different place. That I see as the biggest success of our activities, that we were able to keep the euro area together, because European integration would have faced a very serious setback. The breakup of the euro area, we don't know whether it would ultimately also have led to a breakup of the European Union. So this is not an alternative to working and thinking about population developments. And indeed, our demographic situation in Europe is quite different from other parts of the world. But it's not unique. There are other parts of the world where also population is stagnating or decreasing or will decrease in the foreseeable future. Japan was the first case, already starting 5-6 years ago with a decrease in population. Russia is reaching that point, and China will in 10 years have a decrease in population. Very difficult to say whether that is good or bad in general. It makes economic management more difficult when the population decreases. But does it make sense that the world population continues to grow? We are now at, 7 billion. We know we moved to 9 billion. And then with the demographics that we know, I think we may reach the peak and it will decline. I don't think one should look for further increase from 9 to 11 and more. I don't know where it would end. So this is a very difficult issue, but we have to realize that in a country or region where the population shrinks, economic management becomes more difficult because our economies are all built on social security systems where people expect to get something out of these systems because they pay in while they have a job. They make contributions that are deducted from their wages and salaries, and therefore rightly they expect to get something out when they retire. And they expect to be covered by health insurance. This is a lot easier when the population grows. When the population shrinks, this gets very difficult. And governments have to face that situation. But I don't think I would personally not go as far as say that for that reason, population must always grow. We can still think about the interesting differences we find in Europe. Why are certain countries growing, like France? Still growing, while countries like Italy and Germany are shrinking very soon. The birth rate in Germany and Italy is only around 1.3 per woman. You need a bit more than 2 to have a stagnation in the population. In France, it's 2. Why is it 50% higher in France than in Germany and Italy? That's an interesting question, and that has also something to do with economic incentives, like the tax system, the social security system, but also the attitude of society towards family with 2 income earners, childcare, and all of that. So it gets into many, many other issues that I didn't talk about this morning. But I don't think the alternatives that you had in your question, that one should not have these crisis-fighting institutions, EFSF and ESM, and instead focus on demographics. I don't think that's the alternative. The one is important, the other is also important, but opens many, many other sociological, political, and economic issues. I don't know whether I answered your question, but I tried.
Thank you, Mr. Regling, for your excellent speech covering the various elements of economic fiscal governance, which has been improved. I have a question on something that you did not cover, and that's the credit rating agencies. There was a lot of talk during the crisis that there were conflicts of interest, that the credit ratings were not able to predict the crisis. There were rules that were revamped of the rating agencies. Do you see them now as adequate, as helpful? And how does the recent downgrade of the Commission rating impacts the ability of the ESM to borrow in the markets? Thanks.
Yes, everybody is unhappy with rating agencies. Everybody complains. Some of that is justified because they always seem to be late. So they certainly did not see the crisis coming. Although when you talk to them, they point out that they downgraded Greece 5 times between 2005 and 2008. So they were not completely blind, but they certainly did not foresee the crisis. Most people did not foresee the crisis, to be fair also. Now, interestingly, we are in a phase where rating agencies are beginning to upgrade euro area countries. And every week there's a positive news now. Maybe also a bit late, because the developments I showed on the slides have been clear for the last 1 or 2 years already, but now they react to that also. So that's the question: how early can rating agencies react? And maybe they should do a bit better there. But more broadly, the criticism is also, do rating agencies have too much power? And that's what many people complain about. And there's probably some truth in that, because when during the crisis the rating agency downgraded the country, it really had a significant additional negative impact, so they do have power. But we have to realize that the power was given to them by parliaments and governments. They did not grab this power. They received the power always for good reasons, mainly for consumer protection reasons, because it's impossible for normal small investors to really understand the creditworthiness of different investment possibilities. And therefore, rating agencies have this job of making the rating. And it was governments and parliaments that then write into rules or law directives for insurance companies, for instance, that insurance companies can only invest in certain investment products that have a certain minimum rating. This comes from government and parliaments, not from the rating agencies. And it's for good reason. But when you add up all these directives and rules and laws that have been created the last 20 years to protect consumers, it's probably too much. And therefore, one should think, and some people are thinking about how one can reduce the influence of rating agencies. There's even a special working group at the Financial Stability Board in Basel that looks only into this, how to reduce the power of rating agencies. But it's not easy, because the underlying reasons why each step was taken was a good one. But the problem has been recognized, and we are trying.
Thank you. Markus?
I have a question concerning the stress test done by the ECB. Most probably this will show us that a lot of banks will have a lack of capital, and how's the ESM prepared for that? That's my first question. And the second question is, does Greece need a haircut? You said in your presentation that Greece is most probably need more money, and does the third package contain a haircut?
Yes. On your first part, you said many banks will need capital. I don't know. That's what I read in newspapers sometimes. There's a suspicion in markets among some investors that this might be the case, but it's far from clear. The ECB, and they are now in charge of doing this asset quality review and the stress test together with EBA, they have said repeatedly that they do not expect big problems. So I also do not expect big problems. Particularly in the 5 countries that have borrowed from my institutions, I know the banking sector quite well. We have looked at that repeatedly. The banking sectors in these 5 countries have been scrutinized several times by the supervisors, but also by outsiders like PIMCO, BlackRock. And that's why I'm fairly confident that there will be no big surprises in these 5 countries. Maybe small surprises, but no big surprises. Then if problems show up in Northern European countries, Finland, Germany, Netherlands, the countries will find ways, so it will not be a common problem. So it leaves very few countries where there might be the need to do something. But overall, I have confidence in my colleagues at the ECB when they say there will be no big surprises. But it will be very important to have a good stress test, a credible one, because there is a suspicion out there. You also seem to be suspicious, so that everybody once for all knows exactly what is the situation. That is really important, and that's what needs to happen now. What the ESM could do, at the moment we have 1 instrument available, or 2, let's say. If a country needs to help its banks, it can borrow from the ESM. Either the way Spain did it, only to restructure its banks, so it would get money we would lend money to the government and the money would be earmarked to restructure the national banking system. Or a country can apply, of course, for an overall macroeconomic adjustment program and use some of the money for banks. Then we are developing a new instrument called direct bank recapitalization, where the ESM would directly give money to one bank, so not via the government, but directly to the bank. We are developing that in our institution because we need different staff that has experience in restructuring banks. It's very different to take capital in a bank from lending to a government. So that instrument does not exist yet, but we are preparing it, and the finance ministers of the euro area may decide to give us that instrument. So that would be an additional possibility from the ESM to help in case there's the need. But then the main thing that will be different in the future, already when the results of the asset quality review and stress tests become available in November this year, is that it has been agreed in the future when public money is made available to a bank, there will always be some kind of bail-in. Bailing in means getting contributions from the capital owners, the shareholders, and the bank creditors in a much more systematic way than we did it in the past. There's already agreement on that principle. How much bail-in is still under discussion and should be decided the next few weeks. But there will be bail-in, and that will reduce the need for public money to help the bank. That is the new world into which we are moving. On your second question on Greece, indeed, I would expect that they need a small third program. I don't think it will mean a haircut. There was a substantial haircut for Greece in 2012, where private creditors gave up 57% of their claims. That was a big help for Greece. It was equivalent to 50% of Greek GDP. Now the situation has improved substantially, and I don't see the need for a haircut, unlike some Anglo-Saxon academics who believe that this is unavoidable. But these are the same Anglo-Saxon academics who believed 5 years ago that Latvia must devalue. So I think they don't have that much credibility. The other reason is that now the main creditors of Greece are public sector, mainly the EFSF. And the public sector doesn't do haircuts, except in a very few isolated cases that happened for IMF countries and World Bank countries. These are the poorest of the poorest who had civil war, like Sudan and Liberia. These are countries who also received haircuts on their publicly owed debt. But middle-income countries like Greece have never received that. There's always been a division of labor in these cases that if haircuts are needed, private creditors are asked to do that, while the public sector continues to provide new financing because it doesn't come from anywhere else. And that would be the same situation here.
Thank you. More questions?
I would like to ask about cooperation with Federal Reserve System of Central Bank of United States. In how extent is this cooperation? How big is influence of Federal Reserve System to all money system in Europe? Thank you.
Of course, my institutions, we do not cooperate directly with central banks outside the euro area. But the ECB, of course, has a very close cooperation with the ECB. And we all know that whatever happens at the Federal Reserve and whatever decision is taken by the Federal Reserve has a big impact on the rest of the world. There's a dilemma. Many people call for more cooperation to take this into account. But the Federal Reserve, by its own law, is of course obliged to do what is needed for the US economy. Otherwise, they get into trouble with the US Congress. So there's a dilemma here that on the one hand, we know spillovers exist. Actions by the Federal Reserve have an impact on the rest of the world. On the other hand, they are under their legal mandate to only do what is required by the US economy. So there's a problem here that has not really been solved, I think. You can go a step further. You didn't ask that question, but it's an interesting element that in Europe, in the euro area, we have solved this problem. Because before monetary union was created, we had a similar situation in Europe. What the Bundesbank decided had a big impact on other European countries. But the Bundesbank, by its law, was under obligation to do only what is good for the German economy. And so it was a similar dilemma. With the creation of the euro, this has disappeared because the ECB looks at the euro area as a whole and decides on its policy actions in light of the euro area as a whole. So we have solved this dilemma in the euro area. For the Federal Reserve, it has not been solved.
Thank you.
So about the banking union, how exactly will banking union avoid fragmentation of the financial markets of European Union, and what will be done for the banks that are over border, for example, Great Britain, Sweden, and so on?
Banks that are outside?
Yeah.
Okay. What we are trying, we are trying to reduce fragmentation, so you say how. Well, banks that are supervised by the ECB, by the single supervisor, are no longer supervised by the national authorities. What we have so far is that we have banks, although they operate across borders, they are supervised and governed at the national level. And often, different country by country, national supervisors are sometimes a little bit too lenient with their national banks, which leads into problems over time. The common rules are implemented not exactly the same in every country. So in the end, we have today in the euro area 18 different banking markets. Once banking union exists fully, and that will take a number of years, we will have one banking union. National supervisors don't have the decisive say. It will be the single supervisor. The rules for supervision will become the same. There will be one single rule book. The rules for bank resolution will become identical. So it will be the same approach to close down banks. So it will really become one single market. That's when monetary policy will be transmitted more easily from one country to another. The risk premium that's at the moment required by Spanish banks, by Portuguese banks when they issue their own bonds should decline. And that's when spreads will slowly disappear between the different borrowers inside the banking union. So the fragmentation, that's the purpose of the whole exercise, should really disappear. And I think there's a very good chance of that happening. It will take a number of years because the different elements of the banking union will not be in place immediately. Also, markets have to be convinced that it's really working because it's technically complicated. They have to be convinced that the single supervisor will really play its role fully. And then I think there's a good chance that we will create a real integrated single banking market in the euro area. So banking union at the moment will be for the euro area countries, that's 18. It's open to all the other EU countries, so they can decide whether they want to join or not. At the moment, no country has finally said that they will join the banking union, but I expect that several countries will. There's only one country that has ruled it out, that's the United Kingdom, not surprisingly. So they will certainly not become member of the banking union. All the others are thinking about it, and I would expect that most of them will join.
More questions?
A question on the SRM, the single resolution mechanism. Is this an institution that you think may be able to issue debt in the future? And if so, how might that transformation take place? Also,
the acoustics are very bad. So you say the SRM issuing debt?
Maybe in the future. Is that something that you think may be able to happen, that the SRM may be able to issue debt in the future?
It's one of many proposals on the table at the moment. To be more precise, it would be the SRF, Single Resolution Fund, which would provide the funding to the SRM. The SRF will be funded over a 10-year period by contributions from the banks. After a 10-year period, they will have money equivalent to about 1% of all deposits of all the banks in the banking union. So it will be a 10-year process till they are fully funded. And there's a debate going on what to do in the interim during this 10-year period until the full amount of funds is achieved. And one of the options would be to give the SRF the possibility to fund itself in the market. It's one of the, as I said, many proposals. I don't think it will find a consensus in the end. It's too complicated. I know what I'm talking about because at the EFSF we started from scratch to create an institution that issues bills and bonds. It's not easy. One needs credit enhancement. It takes a while. I don't think euro area countries will find a consensus to repeat that for the SRF. So I don't expect it, but we will see. You are right, it's one of the proposals on the table.
Thank you.
Okay, well, thank you very much. If then no more questions.
No more questions. Then I also would like to thank you very much for coming to our university and for excellent presentation, and wish you all the best on your everyday duties.
Thank you very much.